max out your tax-free savings account every single year. I'm sure that you've all heard this statement being recommended by almost every financial guru in South Africa. And although you may know that you should be contributing towards a tax-free savings account, you may not be exactly sure where you need to actually keep your tax-free savings account in the first place. And that is what this video is all about. Today, I will not only show you where the best place is to open and keep your tax-free savings account, but also what you need to invest into inside the tax-free savings account in order to get the maximum tax benefit as possible and in turn the best possible growth on your investments. So let's dive into it. Now, seeing that there are a gajillion different things that we can invest into nowadays, it will be easier to quickly revise the rules of a tax-free savings account so that we can eliminate a bunch of options that do not qualify for a tax-free savings account in the first place. Seeing that a tax-free savings account is a retirement product, the government implemented a couple of restrictions to minimize your risk, which makes sense because if you invest your entire retirement fund in risky dog coins that do not have any real intrinsic value, then you may end up losing all of your retirement savings, which is not good. So what are these restrictions? You are not allowed to invest in individual shares, physical property, commodities like gold and silver, cryptocurrencies, exchange traded notes, or hedge funds. So that basically only leaves us with ETFs or exchange traded funds, unit trusts, retail savings bonds, fixed deposits, and basic bank savings accounts. So how do we decide between these options? Well, seeing that this is a tax-free savings account, we need to see how we can save the most amount of taxes. And in order to do that, we first need to understand what types of taxes there actually are, as well as how they work. First up is capital gains tax. When you sell an investment for more than what you paid for it and you have kept it for more than 3 years, then the profit you made will be taxed as a capital gain. As South Africans, we all get an annual CGT exclusion of 40,000 Rand, so this will first be subtracted from your capital gain, and then 40% of this balance will be taxed according to your marginal personal income tax rate, which ranges anything from 18 to 45%. So depending on which tax bracket you fall into, you'll pay an effective CGT on the profit of your investments of anywhere between 7.2 and 18%. Next up is dividend withholding tax. When a company makes a profit, they can decide to either invest it back into the company or they can pay it out to their shareholders as a kind of thank you for being invested in their company. This payout is called a dividend, and this dividend is taxed at a flat rate of 20% in South Africa for companies listed on the JSE. Now, some companies are what is called dual listed, meaning they are listed on two different exchanges. For example, Richmond is listed on both the JSE and the Swiss exchange. Then you also get companies that are only listed on a foreign exchange. For example, Apple, that is only listed on the New York Stock Exchange. The dividend withholding tax rate calculation is different for all three of these scenarios, with the US charging a dividend withholding tax of 30% and Switzerland charging a dividend withholding tax rates of 35% for all dividends distributed to non-US residents like us. Thankfully, South Africa has what is called a double taxation agreement with both the US and Switzerland, meaning that you will only pay an effective foreign dividend withholding tax rate of 15% on investments in both these countries. You will then still pay 5% dividend withholding tax to the local South African government, which again totals a maximum effective dividend withholding tax rate of 20% on all dividends received, be it local or global. Now, in order not to get all nerdy with this, as these tax calculations can sometimes get quite complicated, all you need to know is that for local companies, you will need to pay the full 20% to the South African government in the form of local dividend tax. But for dual listed or foreign companies, you will, for the majority of them, pay 15% to the government where the company is listed in the form of foreign dividend tax, and then 5% to the South African government in the form of local dividend tax. This is really important to know, and I will explain why in just a minute. Third, we have interest tax. All the interest that you will receive from bonds or cash investments, which include things like government retail bonds, bank saving accounts, fixed deposits or money markets, will get taxed as interest tax. Now, as South Africans, we all do get an annual interest tax exemption, which is 23,800 for those younger than 65 and 34,500 Rand for those older than 65. Any interest that you receive above these amounts will be seen as income, and this will be added to your personal income, which will be taxed according to your marginal tax rate, which again ranges from 18 to 45%. There is no annual tax exemption for interest received from a foreign source, so all the interest earned from, for example, foreign bonds will be taxed according to your marginal tax rate in South Africa. Now, knowing how all three of these types of taxes work, we also need to quickly look at how the tax structure of real estate investment trusts, or REITs, works. REITs are basically a unit trust or an ETF that tracks the performance of a bunch of properties. Now, the directors of a REIT can effectively achieve a zero tax rate at corporation level should they distribute all of their taxable earnings to the shareholders, which are you and me. In South Africa, REITs are required to distribute at least 75%, and in the US, this figure is a whopping 90% minimum. REITs are therefore incentivized to do so, as the tax penalty and the subsequent loss of REIT status would be a terrible consequence for the company. REITs are also exempt from paying dividend withholding tax, and distributions are therefore taxed in the hands of the shareholders at their respective marginal income tax rates, which again ranges from 18 to 45%. So in essence, all the income that you will receive from a REIT will be added to your personal income and then taxed according to your marginal tax rate. Okay, so now let's take all of this information and see how it applies to a tax-free savings account. Seeing that we are exempt from paying capital gains tax, dividend withholding tax, and interest tax inside a tax-free savings account, it would make sense to invest in a product that usually attracts the most amount of taxes, as this will allow us to make use of the maximum potential of this retirement product, right? So let's start with cash and bond investments, which will typically be offered by most banks. Seeing that we are already getting the annual interest tax exclusion, it will generally not make any sense to put these types of assets inside a tax-free savings account. Why? Because in order to earn any tax benefit from interest income, you will essentially need to earn more interest than the annual exclusion. So if your bank, for example, offers a guaranteed 5% interest rate on its tax-free savings account, this means that your investment will need to be worth more than 476,000 Rand if you are younger than 65, or 690,000 Rand if you are older than 65. And seeing that a tax-free savings account has an annual contribution limit of 36,000 Rand, it will take you more than a decade to reach this amount of capital, which essentially means you will waste more than a decade of the potential of your tax-free savings account, as you would have scored zero extra tax savings and could have been just as well off by putting it in a normal discretionary taxable account. I really hope this makes sense. If it doesn't, then please let me know down in comments so that I can personally come over and drop this into your head, as there are so many people investing their tax-free savings account in bank accounts without knowing any better, and thus they are losing out on the extremely powerful potential of this retirement product. On top of this, income producing assets like cash and bonds tend to underperform growth assets like shares and property. And seeing that a tax-free savings account is a long-term retirement product, you should try and go as aggressive as possible with your asset allocation in order to try and get the maximum returns. Okay, next let's look at dividends. As we've already established, the maximum rate that you'll ever pay on a dividend is 20%, be it from a local or a foreign source. But the tax exemption that you get from dividends is only applied to your local dividends. The IRS does not give a shiz about our local tax laws. They will take their 15% dividend withholding tax no matter what. So on all the dividends you receive from dual listed or foreign companies inside your tax-free savings account, you will essentially only save on the local dividend part, which is 5%. Did you know this? Let me know down in comments if you did, as not many people know about this specific clause. And that leaves us with capital gains tax. This one is a bit tricky inside a tax-free savings account, but I like tricky, so here goes. We all know that you will trigger a capital gain when you sell your investments for a profit after about 3 years, right? Now, if you bought and sold a local ETF, then your capital gains tax will be calculated as normal, as I explained earlier in this video. So no funny business here. But now, if you are invested in a rand denominated offshore ETF, such as the CoreShares Total World or the Satrix MSCI World, your profits will be determined not only by the growth of your investment, but also by the currency fluctuation by the time that you sell your investments. This means that even if your investment's value did not go up, but the rand weakened against the US dollar by the time you sell it, you will still trigger capital gains tax. I explained this in much more detail using examples in this video, so make sure to go check that out so that you can fully understand how this works. It is really important that you know this. Now, seeing that the rand weakens against the US dollar at an average rate of about 2 to 4% per year, this means in terms of rand value, your rand denominated offshore ETF's value will also go up at an average rate of 2 to 4% thanks to a weakening rand. This will usually be a problem in a normal discretionary taxable investment, as you will need to pay capital gains tax on both the increase in value of your investments as well as the currency fluctuation. But because you are now exempt from capital gains tax inside a tax-free savings account, this is actually a good thing for you. Okay, so now to tie this all together and to decide on the most optimal asset allocation inside a tax-free savings account. We know that bonds and cash are crap, so we can exclude things like fixed deposits, bank savings accounts, and government retail bonds immediately. That basically leaves shares and property assets either in the form of unit trust or ETFs. From a pure tax perspective, REITs are the most tax efficient product that you can put inside a tax-free savings account, as you will save a massive amounts of taxes on its distributions, which can be as high as 45%, as well as on its capital gain, which can be as high as 18%. If it is a rand denominated offshore REIT or property ETF, then you will save even more on a weakening rand. So theoretically, a REIT like the 91 Property Equity Unit Trust, or a local property ETF like the Satrix Property, or a global property ETF like the Signia Global Property ETF would be the best bet for tax-free savings account. But you know that when I say theoretically, does not necessarily mean that this is the best choice. Tax savings alone should not dictate your investment decisions. Asset allocation is a much more important driver for investment performance. And seeing that shares typically do outperform property in the long term, and that your biggest tax savings will essentially be on capital gain, it would make more sense to invest in unit trusts or ETFs that track global shares, such as the PSG Global Equity FIDE Unit Trust or the CoreShares Total World ETF. Why not local share ETFs? Even though you will save more taxes on the local dividend payouts of 20% versus those of foreign dividend payouts of 5%, I still believe that capital gain will trump dividends in the long term, And together with the currency fluctuation, I will bet that foreign shares will be the most optimal asset to put inside a tax savings account in the long run. So if you want a simple investment strategy, then I'd say go 100% into the core shares total world ETF. But if you want a bit more diversification, which is always very important, then you can always split up your tax-free savings account allocation as 80% into the core shares total world ETF and 20% into the Signia global property ETF, thereby capitalizing on the tax benefit of both. You can go even further by splitting it halfway between local and foreign investments, meaning 40% into the core shares total world, 40% into the Satrix top 40, 10% into the Satrix property, and 10% into the Signia global property ETF. Just remember that your tax-free savings account should form part of your overall investment strategy. So try and shift its allocation to be as tax efficient as possible while still making sure that it makes financial sense in the big overall picture. Okay, so now the question. Where do I need to open or keep my tax-free savings account? Apart from your asset allocation and tax savings, the third most important thing to keep in mind when deciding on a tax-free savings account is the fees that you will be paying. Lower fees usually translate to higher returns. So it will make no sense to pay ridiculous fees to a financial advisor to manage your tax-free savings account on your behalf, as it is really easy to do it yourself. It will also not make any sense to pay an annual platform fee, as that will consistently erode your investment returns every year, and you also don't want to pay any sign-up fees, nor do you want to be penalized when changing, stopping or restarting your debit order. Now, you will notice that most banks offer tax-free savings accounts, but the majority of them only offer it in the form of fixed deposits, which we know by now is crap. So avoid banks at all costs. Then you get insurance providers that will actively manage your tax-free savings account on your behalf. These typically come at a higher fee, usually with a EAC of above 2.5%, which I also don't like. So that leaves us with investment platforms that allow you to invest in passive ETFs or unit trusts without charging an annual maintenance or account fee, and who gives you access to all the ETFs and unit trusts that your heart can possibly desire. So to make things very simple for you, I will cut down the list to one: Easy Equities. They offer the most diverse amount of ETFs and unit trusts. They only charge a brokerage fee, not an ongoing annual fee, and if you sign up by using my link down in the description, you will get a free 50 Rand cash voucher. Easy Equities is loved by the majority of investors in South Africa, and I can personally vouch for them, even though they still have not sponsored a single video of mine. So if you haven't already, go and open an account with them. I have a full comprehensive tutorial on how exactly you can do that over here, so you really have no excuse. And if you want to know if it is better to invest a lump sum into your tax-free savings account at the beginning of the year, or if you should rather phase in your money over a period of 12 months by means of rand cost averaging, then go check out this video. If you found this video helpful, then please clap that choppy so that the YouTube algorithm can show this video to more people. Thank you for watching, and I'll see you in another video next week. Cheers!